Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Hello students, this is Dr. Dhaval Nakum from Gujarat University. Welcomes you all to the fifth part of Fundamentals of Accountancy. Previously we have covered concept of double entry bookkeeping system, that is we have learned how this system works in the practical field. Then features of double entry system. The features of the double entry system clarify any misconception about it, and important features include the debit and credit effect of each transaction with identical value and the requirement that the total of debit and credit effect remain the same. Then the stages of the double entry system, that is the stages of the double entry system explains its process to reach the financial destination, which is the preparation of the final accounts. Then we have also covered benefits of double entry system, that is every system has its own useful effects. The double entry system provides various benefits to its users such as the measurement of the profitability, disclosure of financial position, usefulness for the managerial decisions and fraud detection. We have also discussed the dual effects of transactions with the help of the illustrations, and lastly we have covered the illustrations on accounts to be debited and credited from the given transactions. In this part 5 of Fundamentals of Accountancy, we will discuss about the types of transactions, then types of assets and liabilities, and fundamentals of accounting equation. Let us commence with the types of transactions. The very first is types of transactions. We have acquired fundamental information about bookkeeping and accounting. Accounting is treated as both an art and a science. It is a rich subject of social science. In accounting, all transactions are categorized into different categories. There can be a title based main category that include various subcategories as well. When a subcategory title works as the main category, another main category can be its subcategory. Let us understand this with an understanding of types of transactions. The types of transactions are the cash transactions, credit transactions, capital income transactions, capital expense transactions, revenue income transaction, revenue expense transactions, goods related transactions, trading account related transactions, profit and loss account related transactions, and finally the balance sheet related transactions. So let us understand these categories. There are two main transactions, cash and credit transactions. First let us see cash transaction and its subcategories. Cash transactions, capital income and capital expenses. Under this category, each transaction is done in the form of cash or bank. It means either cash or bank is received or cash or bank is paid for the transaction pertaining to the assets and liabilities. However, the frequency of such transactions are almost zero. This category deals with the assets and liabilities. When cash or bank is received from the sale of assets or when funds are raised, it is treated as a capital income transactions in accounting. For example, it includes the sale of plant and machinery, sale of furniture, sale of investments, issue of equity share capital, loan from the banks and issue of debentures. When cash or bank is paid for the purchase of assets or when funds are redeemed, it is treated as a capital expense transactions in accounting. Examples include the purchase of plant and machinery, purchase of furniture, purchase of investments, buyback of equity share capital, reduction of loans and reduction of debentures. You have to note that all capital income and expenses are items of the balance sheet such as plant and machinery, furniture, investments, equity share capital, bank loans and debentures. Now we will talk about the revenue incomes and the revenue expenses. Under these category, each transaction is done in the form of cash or bank only. It means either cash or bank is received or cash or bank is paid for transactions pertaining to recurring income and recurring expenses. When cash or bank is received from the sale of goods, income from commission, rent, interest, dividends, etc., these are treated as revenue income transactions in accounting. The occurrence or frequency of such transactions is regular and these income takes place at specific intervals. When cash or bank is paid for the purchase of goods, salaries, rent, interest, commission, discounts, administrative expenses, selling expenses, etc., these are treated as revenue expenses transactions in accounting. Now, let us see the credit transactions and its subcategories. Credit transaction, the first bifurcation is capital incomes and capital expenses. No cash or bank dealing are done for such transaction and that is why it is known as the credit transactions. It means neither cash bank is received nor paid for the transactions pertaining to assets and liabilities. The frequency of such transaction is almost 0 and these categories deal with the assets and liabilities. In such transaction, capital income are due but not received. Like calls in arrears is an illustration of capital income. It is the amount of calls due but not received from the shareholders. When assets are acquired on credit, for example, a plant is purchased on credit and payment is to be made after 6 months, this transaction is a capital expense and cash or bank is not paid in the present. Thus, it is a credit transaction of capital expenses. Second category is revenue income and revenue expenses. No cash or bank dealings are done for such transactions, very similar to the capital credit transactions. It means neither cash bank is received nor paid for the transactions pertaining to revenue incomes and revenue expenses respectively. In such transactions, revenue incomes are due but not received. Example includes commission due but not received, interest due but not received, etc. There can also be transactions for revenue expenses. For example, salary due but not paid, rent due but not paid, etc. All capital incomes are disclosed on liability side of the balance sheet and all capital expenses are disclosed on the asset side of the balance sheet. Note that all revenue incomes and expenses are items of the profit and loss account or income statement. Next point of our syllabus is types of assets and liabilities. These points were already discussed in part 3 of the fundamentals of accountancy. You are advised to refer to the respective part to refresh these aspects. For the commencement of any business unit, capital is needed, and when sufficient capital is not available, liability is created. So, the total of capital and liability is invested in different assets as per the needs of the business unit. Thus, in financial accounting, the total of capital and liabilities equalizes the assets. So, in the form of equation, capital and liability with assets can be represented as equity plus liability equals to assets. For further clarification, the equation can be presented as equity plus long term liabilities equals to fixed assets plus current assets minus current liabilities. Let us study the accounting equation, the fundamentals of the accounting equation. The final destination of financial accounting is preparation of annual or final accounts. This includes preparation of trading account, profit and loss account and a balance sheet. In big organization, no trading account is prepared and instead of trading account, P&L account or income statement is prepared. Income statement discloses profit or loss of the business taken place in respective accounting year only, and balance sheet discloses economic condition of the business unit of the respective day, generally the last day of the accounting year like the 31st March of each year. And under traditional approach, specific chronological order is followed for preparation of final accounts. Under these order, first the nature of the transaction is identified and recorded in the journal book or subsidiary books. Then in the second stage, posting is done in the ledger book in respective accounts. In the third stage, trial balance is prepared, and then in the fourth and final stage, final or annual accounts are prepared. So, accounting equations and transactions. In the equation approach, the effect of a transaction is directly given to the assets, capital and liability side. Listen carefully, in the equation approach, the effect of a transaction is directly given to the assets, capital and liability side. When using the equation method, business transaction can be classified to understand the method more easily. Let us see the classification of business transactions for application of equation method. Transactions related to goods, purchases, sales, purchase return, sales return and goods goes out in any other form is part of these particular transactions. Then second is revenue expense related transactions, rent received, commission received, dividend etc. are included in the revenue. Salary, wages, advertisement expense, administrative expense etc. are included in the expenses. The third category is asset purchase sale transaction. Fourth category is transactions related to borrowing of funds and lending of funds. There can be different effects on A is equals to C plus L of classified transactions. Here effect A stands for the assets, C stands for the capital and L stands for the liabilities. These effects can be, one is increase and decrease in A only, that is asset only. It means increase in one asset and decrease in another asset. So, it makes the equation equals to the A is equals to C plus L. Then second is increase or decrease in A and C both. Then third is increase or decrease in A and L both, and then lastly the increase or decrease in C and L both. Let us understand these situations with illustrations. Let us see the illustration number 1. Journal entries for business of Mr. Ram Krishna are passed. Their accounting effect in the form of accounting equation are explained. Let us understand this illustration. First of all, let us understand the columns prepared here in this illustration. The number 1 is serial number, then we have prepared transaction and journal entry, then debit and credit amount, then effect and finally the equation, accounting equation, that is A assets is equals to C capital plus L liability. The very first transaction is brought rupees 50,000 and commenced business. Here cash account gets debited and capital account is credited, because cash is asset of the business, debit whatever comes in. So, we are debiting cash account and owner is the giver of the cash. So, owner is giver of the benefit to the business. So, capital account is credited. Now, see the effect, that is assets which is cash which is increased here and capital is also increased. So, see the accounting equation, A asset 50,000 is added in the column and then C capital 50,000 is also added in the respective column. The total of A assets 50,000 makes equals to the total of C plus L, that is 50,000 plus 0 liability as of now. So, 50,000 is equals to the 50,000. The next transaction is furniture purchased for rupees 10,000. Here furniture is an asset. So, debit whatever comes in, furniture account gets debited and cash goes out. So, we are crediting cash account with the same amount of 10,000, 10,000. Furniture is an asset. So, furniture is increased. So, we are adding 10,000 in the assets and then again cash is going out of the business. So, we are deducting 10,000 from the assets. So, 50,000 plus 10 makes 60 and again we are deducting 10,000 of cash, that is 50,000 again. So, total of asset equals to capital plus liability remains same as it is 50,000. equals to 50,000. Third transaction is goods for rupees 12,000 purchased in cash. Here goods comes in the business, so purchase account gets debited, and cash is going out of the business, so cash account gets credited with the amount of 12,000. This is also a similar example of asset is increasing and asset is decreasing. So we are adding 12,000 on the asset side because of goods comes in the business, and we are deducting 12,000 from the asset side, that is cash is going out of the business. So our equation will remain as it is, 50,000 of assets is equals to 50,000 of capital plus 0 liability. The next transaction is goods for rupees 8,000 is purchased from B. Here goods comes in the business, so purchase account gets debited and B's account is credited with amount of 8,000 rupees. As goods comes in the business, effect is asset is increased. So we are adding 8,000 in the asset, and liability is also increased as we have purchased goods from B on credit. So we are adding liability of rupees 8,000 in liability column. Now the total is asset of 50,000 plus 8,000 of purchased goods makes a total of 58,000. We have already a capital of 50,000 and we have added a liability of 8,000. So 50,000 of capital plus 8,000 of liability makes an equals with the assets of 58,000. Next transaction is goods of rupees 7,000 is sold for rupees 10,000 in cash. Here we have received cash of 10,000 rupees. So cash account gets debited with 10,000 amount, and sales account is credited as goods is going out of the business. So sales account also gets credited with amount of 10,000. As cash is received, so asset gets increased by the amount of 10,000. So we are adding 10,000 in the asset column. Then goods is going out of the business, so we are deducting 7,000 because goods of 7,000 is sold for 10,000. So here goods is going out of the business for the amount of 7,000 only. So we are deducting asset of 7,000 from the assets column, and here we have made a profit of 3,000 rupees. Now remember carefully that profit is always added to the capital and loss is always deducted from the capital. So we are adding profit of 3,000 in the capital. Next transaction is rupees 6,000 paid for wages. So wages is an expense. Wages account gets debited with 6,000 amount, and we have paid the cash. So cash account gets credited with the amount of 6,000. Here capital is decreased as we have paid the expenses. So whenever we pay any expense, our capital gets reduced, and whenever we receive any income, our capital will be added. Here so capital is decreased with the amount of 6,000, and asset, that is cash, is also decreased. So we are decreasing the asset by 6,000 same amount. So earlier we have a total of 61,000 on the asset side, now which is reduced to the 55,000 after deducting the cash of 6,000 rupees. And in case of capital, earlier the total was 53,000 and now we have deducted 6,000 for the expense of wages. The new total is 47,000. Liability of 8,000 will remain as it is. So assets of 55,000 equals to the capital of 47,000 plus liability of 8,000 makes an equal equation. Next is wages outstanding rupees 1,000. Wages account gets debited by 1,000 to outstanding wages account of 1,000 rupees. Now remember that wages is an expense, so we have debited, and outstanding wages becomes the liability. So we have credited. Here capital is decreased by the amount of 1,000 as wages is our expense, and liability of 1,000 is increased as these wages is outstanding as of now. So we are reducing 1,000 from the capital and adding 1,000 in the liability. So accounting equation will remain same as it is, 55,000 of assets equals to 46,000 capital plus 9,000 liability. Next transaction is commission received rupees 4,000. Cash account gets debited by the amount of 4,000 and commission account gets credited by the amount of 4,000. As we are receiving commission of 4,000 rupees, cash comes in the business, so we have debited the cash account, and commission is our income, so we have credited the commission account. Here asset is increasing as cash comes in the business by the amount of 4,000 and capital is also increased as commission is our income. I am repeating again, expenses are always gets deducted from the capital and income is always added in the capital. Here commission is our income, so we have added to the capital of 4,000 amount. Now the accounting equation is 59,000 of assets equals to 50,000 of capital and 9,000 of liability. Next transaction is dividend receivable rupees 9,000. Now we have received the dividend worth rupees 9,000. So cash account gets debited by the amount of 9,000 and as dividend is our income, we have credited it by the amount of 9,000. The effect is cash is increased, so asset is increased. So we are adding to the asset side by the amount of 9,000 and dividend is our income. So income is always added to the capital. So capital is also increased by the amount of 9,000. Now accounting equation is 59,000 of assets plus 9,000 of cash received. It makes total assets as 68,000 equals to the capital of 59,000 plus liability of 9,000 rupees. 10th transaction is machine purchased rupees 8,000. Machine is our asset, so we are debiting the machine account and crediting the cash account. As machine is asset, we are buying the machine, we have purchased the machine. So machine means asset is increased by the amount of 8,000 and we have paid for the machine rupees 8,000. So we are also deducting the cash of rupees 8,000. So on only one side the effect is given in the equation, that is 8,000 of asset is increased and 8,000 of asset is decreased. So our equation will remain same as it is. 68,000 of assets equals to 59,000 of capital plus 9,000 of liability. Next transaction is land purchased from Radha for rupees 25,000. Land is also an asset of the business. So whatever comes in we have to debit. So land account gets debited by the amount of 25,000 and Radha's account gets credited by the amount of 25,000. As the name is mentioned Radha, we have to assume that it is a credit transaction. So we have purchased land from Radha on credit, so liability towards Radha is created. Here the effect is asset is increasing as we have purchased the land by the 25,000 amount and liability is also increased by the amount of 25,000. So the new equation is assets equals to 93,000 is equals to capital of 59,000 plus liability of 34,000. Next transaction is borrowed bank loan of rupees 20,000. Here we have borrowed the bank loan, so cash comes in the business, so we are debiting the cash account by the 20,000 rupees to the bank loan account as bank is the giver of the cash, that is loan. So we have credited the bank loan account by the 20,000 rupees. On the effect side, as cash is received, asset is increasing by the 20,000 and liability towards bank is also increased by the 20,000 rupees. So now the accounting equation is assets is equals to capital plus liability. So 1,13,000 asset is equals to 59,000 capital plus 54,000 liability. Now after having treatment of given transaction, total of asset side A and total of capital plus liability is equal, that is asset equals to 1,13,000 and capital of 59,000 plus liability of 54,000 is also equal to the 1,13,000. To clarify the accounting equation and to give more clarity about the accounting equation, the following table is prepared. Here transactions, different assets, capital and liabilities related columns are prepared. From the above transactions, it is ascertained that there are few transactions pertaining to the assets. One is cash, furniture, goods, machine and land. So, accordingly we have prepared 5 different columns of assets. Then capital account is divided in 2 parts, which is capital of the owner and then profit. And similarly, transactions related to liabilities includes transaction with B account, outstanding wages, Radha's account and a bank loan. So, only 4 liabilities related transactions columns are prepared. The first transaction is brought rupees 50,000 and commenced business. Here cash column is entered with the amount of 50,000 and capital column is entered with the amount of 50,000. Second transaction is furniture purchased for rupees 10,000. So, we have paid cash of 10,000. So, we have deducted 10,000 from the cash column and we have added 10,000 in the furniture column. The third transaction is goods for rupees 12,000 purchased in cash. So, we have deducted 12,000 from the cash account, cash column and then we have added 12,000 in the goods column as we have purchased goods in cash. Then fourth transaction is goods for rupees 8,000 is purchased from B. So, we have added 8,000 in the goods column and then we have put 8,000 in B's account, that is liability towards B. Next is goods of rupees 7,000 is sold for rupees 10,000 in cash. So, here goods is sold for 10,000 in cash. So, in cash column we have added 10,000, but we have sold goods worth rupees 7,000 only. So, we have deducted 7,000 from the goods and 3,000 of profit is put over here in the profit column. Next transaction is 6,000 paid for the wages. So, as we have paid for the wages, 6,000 is deducted from the cash column and 6,000 is also deducted from the capital column. Then wages outstanding rupees 1,000. So, again 1,000 of wages is our expense. So, we have deducted 1,000 from the capital column and we have added 1,000 rupees in outstanding wages column, that is liability. Next is commission received rupees 4,000. So, 4,000 is added in the cash column and 4,000 is also added in the capital column. Next is dividend receivable rupees 9,000. So, as we have received dividend 9,000 rupees, 9,000 is added in the cash column and 9,000 is also added in the capital column as it is income of the business. Next is machine purchased rupees 8,000. So, 8,000 rupees is deducted from the cash column and 8,000 rupees is added in the machine column, that is also an asset. Then land purchased from Radha for rupees 25,000. So, land account, land column account 25,000 rupees and Radha's account 25,000 rupees. So, asset of 25,000 is added over here and liability of 25,000 is created towards Radha. Last is borrowed bank loan of rupees 20,000. So, we have received cash, we are adding 20,000 in the cash column and we are adding 20,000 in the bank loan liability column. So, if you make a total, then cash column is tallied as 57,000 rupees. So, in first transaction we have received 50,000, then we have paid 10,000, 12,000, then again we have received 10,000, we have paid 6,000, then again we have received 4,000 for the commission, 9,000 for the dividend, then we have paid 8,000 for the machine and finally we have borrowed loan for 20,000. So, total of cash is 57,000. Likewise, total of furniture is 10,000, total of goods is 13,000, total of machine is 8,000 and total of land is 25,000. So, all these 5 columns makes total of all the assets as rupees 1,13,000. In case of capital, the capital of 56,000 plus the profit of 3,000 makes the total capital column as 59,000, and in case of liabilities, 8,000 of B's account, outstanding wages 1,000 rupees, Radha's account 25,000 rupees, and then bank loan account 20,000, which makes a total of all the liabilities together as 54,000. So, in total A is equals to C plus L, that is assets of 1,13,000 equals to capital of 59,000 plus liabilities of 54,000. Students, on the basis of the above table, we can prepare a balance sheet. Here, the first column shows the cash of 57,000. So, on the asset side, we have put over here cash of 57,000. Then, next column was furniture of 10,000. So, again furniture is also an asset. So, we have put furniture as 10,000 on the asset side. Then, goods of 13,000. So, it was also placed over here goods in asset side at rupees 13,000. Then, machine of rupees 8,000 and land of rupees 25,000. So, makes a total of all the assets as 1,13,000 rupees. Now, next column in our previous table was of capital of 56,000 plus the profit of 3,000, which makes a total of capital as 59,000. Now, we are left with the liabilities. We have 4 different columns of liabilities in our previous table, that is B's account, outstanding wages, Radha's account and bank loan account. Here B's account total of 8,000 is put over here in balance sheet on the liabilities side. Outstanding wages of 1,000 is also placed, Radha's account 25,000 and bank loan as a liability of 20,000. If we make a total of capital and liabilities, it is also 1,13,000 equals to the assets of rupees 1,13,000 rupees. To prepare final accounts, the accountant must pass through different stages under the traditional system of financial accounting. Annual accounts are prepared based on the journal, subsidiary books, posting, trial balance and adjustments. There are 3 components of annual accounts. First is trading account, second is P&L account and third is the balance sheet. Under the double entry system, balance of trading account is transferred to the P&L account. The balance of P&L account is transferred to the capital account in balance sheet. And finally, balance sheet discloses the financial state of the business. Under the equation method, all rules of accounting are followed, but the balance sheet can be prepared directly from the transactions. Let us recollect the information which we have acquired in this part number 5 of fundamentals of accountancy. What we have covered so far, first is types of transactions. Types of transactions are mainly categorized into 2 categories, that is cash transactions and credit transactions. Both are further categorized into capital and revenue transactions, and again the capital and revenue transactions are studied as incomes and expenses. Then we have talked about the types of assets and liabilities. Their classification plays a significant role in financial accounting. Then we studied the traditional accounting system, and along with the traditional accounting system we have used the accounting equation method as well. How the accounting equation, that is A is equals to C plus L works, was understood with one illustration as well. Now, in the next module, that is part B of unit 1, we will discuss capital, revenue, deferred revenue expenses, reserves and provisions, and what are the contingent liabilities. For better understanding of next module, you are advised to refresh all 5 modules of fundamentals of accountancy. I hope you have enjoyed this session. Thank you.